Welcome back. Now, at the half-year mark, Spar has posted a near 8% decline in headline earnings per share and declared no dividends. This as the the retailer operates grapples with inflation cost pressures, along with the impact of the higher for longer interest rate narrative playing out globally. And closer to eliminating one problem, the group has signed terms to dispose of its Poland unit. Company CEO Angelo Swartz joins us with greater perspective on the balance sheet and where the group is headed. Angelo, an absolute pleasure. Good afternoon.
Thank you very much for having me.
All right, Angelo, good afternoon. We did see the revenue line up quite a bit. Of course, that didn't quite trickle down to the bottom line, but there is quite a colourful story there in that income statement. Just talk to us about it, please.
Yeah, so I guess that's one way of describing it. So sales up 7.9%, I think, buoyed by our foreign businesses and a weakening in the rand in the period. Having said that, our Irish business unit growing nicely at 7% in local currency. Our South African business growing just shy of 5%. Having said that, really strong growth for our retailers. Our retailers growing upward of 7% in SA, which indicates a gain in market share. So we're really pleased about that. But our wholesale business not keeping pace, which is something that we need to deal with and have a few plans in place to get us back up to that level of growth. Our Swiss business really coming under pressure from a sales perspective, but the management team in that business doing an exceptional job in terms of managing cost and margin. So seeing operating profit up nearly 10% in local currency, which is an absolutely fantastic performance. Up 20% in ZAR, obviously benefiting from that. From the translation gain there. And then our Polish business being able to provide certainty to the market in terms of our plans to exit that business by the end of this financial year, as we had indicated at our last results presentation, I think is something that's been really well received.
I'd like to actually speak about that Polish business because, of course, those terms there to exit are quite clear. But we have also seen that the acquirer would like to keep the Spar brand. What does that essentially mean for Spar? It's a very interesting dynamic, Angelo.
Yes, so Spar South Africa, or the Spar Group Limited, being the South African business, owns licenses for Spar in South Africa, Poland, Switzerland, Ireland, the southwest of England and Sri Lanka, which are essentially the countries we operate in, as well as the balance of the SADC countries. So we own those licenses, and we receive them from Spar International, which is a Dutch-based company. Spar, the Spar brand is a brand that operates in 48 countries around the world under license from Spar International. We essentially, as part of the sale, sell on that license to the purchaser, and they then operate under license from Spar International, the same way as we do in South Africa, Ireland, and Switzerland, and Sri Lanka. Yeah.
Very interesting indeed. I want to also speak about the cost environment here, of course, bound to cause some margin squeezes globally. Of course, we do see the environment in Europe a little bit more friendly in terms of inflation, but here at home, still some strain. Angelo, just help us understand what that picture looks like, please.
Yeah, I mean, I think in that sense, there's a relativity to it. So the European environment's much less accustomed to operating in inflationary times. I guess the world had become so stable in Europe that there being any form of inflation was a shock to the system there. So whilst inflation in absolute terms is lower in Europe than it is in the South African environment, from a relativity point of view, probably higher there, relatively to where they're accustomed to being. South African inflation coming back to sort of normal levels, but has been at elevated levels for some time. It's an environment we're used to operating in, and so nothing too unusual from a retailer perspective. I think what is challenging there is the pressure that puts on the consumer. And the South African consumer really being under strain, and something that we are trying to shield the consumer from in the business, and I think us containing internal inflation to 7%, well below the average of food inflation over the period, is indicative of that.
I'd also like to touch on what we're seeing with the IT system and SAP and where we are in terms of that one, Angelo. I think are also still coming up in this set of numbers.
Yeah, so the SAP or ERP implementation in KZN has been a real challenge for our business. When we implemented at the beginning of last year, within a short amount of time, it became very apparent that there were three big challenges that hadn't been adequately catered for in terms of the design of the system. One was that the experience of our retailers in terms of getting stock on time in the quantities they wanted was not working as well as it should. Secondly, productivity was seriously impacted across our business, and in a low margin business like ours, productivity management is exceptionally important. And then thirdly, our gross margin wasn't immediately apparent, but it became apparent later that our gross margin was significantly impacted. I think we've grappled and come to terms with the first two. So from a retail experience point of view, certainly much better than it was immediately after the rollout, and almost back to normal now. And we are seeing sales in the KZN area return to pre-SAP levels, or they have, not seeing them return, they have returned to pre-SAP levels, albeit at lower loyalties than we've been accustomed to. But that's no longer up, and because of the system. Our productivity was impacted, and in the last quarter or so, we've really been able to find productivity gains and return to pre-SAP levels. What we haven't been able to do yet is manage our gross margin. And our gross margin in the KZN business is probably 2% lower than what we've been accustomed to pre-SAP. And we really need to manage that back to normal now. We've identified what the issues are. There are two major fixes that need to be implemented. We plan on deploying those towards the end of August, early September, which will be towards the end of our second 6 months. So I don't foresee a meaningful improvement in South African margin in the next 6 months, but starting to return to normal in Q1 of our 25 financial FY25. So I think that's what I can say about SAP for our ERP rollout.
That's all we have time for this afternoon, Angelo, but it's been a pleasure hearing from you, and I hope we can catch up in the next few months with a full year picture. That was Spar CEO Angelo Swartz.